Mine. I don't know. Devina. Hello. So who can remind us of the measurement basis?
Yeah, good evening, everyone.
Yes. Good evening, Mr. Daniel.
Sorry, can you hear me? Good evening, everyone. So, the measurement basis, we discussed about the historical cost, the current value, and the current cost measurement basis.
All right. Who else can remind us? Who else can talk? I believe it wasn't only Mr. Daniel that was in the class last week. Okay, Mr. Ismail.
Good evening, sir.
Yes, good evening.
So, from what I met last week, because I joined late rather. So you taught us about measurement of elements, in which we discussed the fair value, current cost, historical cost, and you gave us an insight into each. I think for fair value, you you said fair value is a price received to sell an asset or pay to transfer a liability orderly in an orderly transaction in a monthly date. That's for fair value. And you talked about current cost as well, which is also replacement cost of an asset or similar to its current cost. And you talked about value in use, which is derived from an asset by its constant usage.
All right. Thank you. Thank you so much. So, today we are moving straight to chapter 7, which talks about presentation and disclosure. Presentation of financial statements and disclosure of element of financial statement. So, uh, chapter 7 of this framework talks about the need for a consensus So, like I was saying, sorry for that break. It talks about the need for a consensus presentation and disclosure, not just between periods of accounts, but across different entities. So, following the principle of this framework, if you pick up a financial statement of an entity, or let me say of two entities, it should give you almost the same line items. So the presentation and disclosure of a financial statement or financial statement element should not differ significantly between industries or between entities in same industry. So chapter 7 of this framework talks about classification of asset and liability of a similar nature together. So assets that have a similar nature, all of them according to chapter 7 should be grouped together and shown as a line item. When you go to the notes to the financial statement, you may have them separately, but on the face of the financial statement it should be grouped as one. Like if you pick a financial statement of an entity, you will not see motor vehicle, plant, and other machineries. You will only see PPE or non-current asset, because non-current assets have similar features. So according to chapter 7 of this framework, it should be grouped together. Same thing with current asset. If you go to liability, the same thing. So we should according to this chapter, when presenting items of financial statement, they should be grouped together, right? Then it also says that we should avoid unnecessary detail that can hinder the importance of the financial statement. So all other details may be in the notes to the financial statement, but there mustn't be, or there shouldn't be, on the face of the financial statement, right? Then it also specified that we should avoid standardized approach, often referred to as boilerplate, but instead giving the entity an opportunity to provide details relevant to the organization and its business. So according to this chapter 7, entities are not bottled or are not in a cycle to follow one standardized approach, right? They are allowed to disclose informations that are necessary or relevant to the entity. So we see that this chapter 7 of the framework relates to IAS1, which is the revised presentation of financial statement. And it says financial statement should be presented to represent the fair and true view of the entity's financial operations, and it must be prepared in line with all the standards, all the accounting standards, right? So before we continue, let me ask this simple question: who can tell us the full meaning of IAS? No, Ismail, not you again, please.
Yeah, international accounting standard. International accounting standard.
Yeah, yeah. All right, all right. So what of IFRS?
International financial reporting standard.
All right, thank you.
Thank you.
So,
So,
presentation of financial statement should comply with all the provisions of the accounting standards, all the provisions of the international accounting standard or international financial reporting standards, as the case may be. So, like I said earlier in our class, all that we'll be doing in this course are all towards preparation and presentation of financial statement, right? I believe I said that earlier. So that is what we'll be looking at. So in a layman terms, we'll be learning how to prepare financial statements. That is what we'll be learning in this class. That is everything that this course entails, right? So quickly, let's look at the last chapter, which is chapter 8, the concept of capital and capital maintenance. So the concept of capital and capital maintenance. There are two concepts of capital under this framework. We have the financial concept and the physical concept. Mary, please mute your mic. Mary or Chanya. Good, thank you. So we have the financial concept and the physical concept, right? And the framework gives allowance to entities to select the appropriate concept of capital that is based on the needs of the users of financial statements, right? So let's continue. Like, take for instance classification of asset or classification of item into asset or liability and into different or separate components can give information or relevant information to the users of financial statement. Like we saw in chapter 7 that similar item of similar characteristics should be grouped together and reported on the face of the financial statement as a single item or as a single line item. Then we also have another form of capital, which is offsetting offsetting of similar items or dissimilar items. Now, according to this standard, you can offset items of same category against each other, but offsetting item of different category or of dissimilar characteristics is not appropriate and is not allowed according to this standard. So what that means is you cannot offset a current liability against a non-current liability. It is not allowed by the standard or by the framework. So with that, we have come to the end of the conceptual framework of financial reporting, right? So we need to read more. Like I said in our first class, each topic we treat like this, we need to read more on such topic because the time we have is limited and we have a lot to cover, so we cannot cover everything in class here. We only touch the basics so that when you are reading on your own, you understand the basics, right? So that is the main aim of this tutorial. So I urge every one of us to read more on this. Is that clear?
Yes, sir.
Yes.
All right. So we move now to the accounting standards. So the first standard we are looking at today is IAS2, which is inventory. So who can define what is an inventory? I'm waiting. Okay, Mr. Ibrahim, let's hear you. Mr. Ibrahim, talk, let's hear you.
Hello, sir. Yeah. So basically, inventory are um, goods or materials that are held by a company for sale. And do you know what I said, sir?
Okay, Mr. Ibrahim, thank you. Though my network did not allow me to hear you well. But Mr. Daniel said inventories are item held for sale. Yes, that's part of inventory, but that's not all the definition of inventory? If you say inventory are goods held for sale, what of raw material? Are they not part of inventory? Mr. Daniel, are raw materials not part of inventory?
They are, sir.
All right. So that definition of inventory asset held for sale is not generic. It's not complete, so to say. So inventory means different things to different people, right? To a seller, inventory can be asset held for sale. But mind you, we have a standard for asset held for sale, that is non-current asset held for sale. This is not what we are talking about here. Inventory is a current asset. So when we are talking about non-current asset held for sale, we are not talking about inventory. Inventory are assets held for sale in the ordinary course of business. That is to sellers or to traders. To manufacturer, inventory can be finished goods and also raw materials, right? So inventory means different things to different people. To a seller, inventory means a stock in trade. That is what you have in stock that you sell, right? That is what inventory is to a seller. Now let me quickly give this instance and also ask a question. We all know that building is an asset, right? And it can be classified as either investment asset, that is IAS 40, or PPE, which is IAS 16, right? So it can be seen as a non-current asset. But take for instance a company that is into real estate, that is into construction of building and selling, or buying of building and selling. Now let's say they have like 100 units of 2-bedroom flat each in an estate in Lekki, Lagos State. How do you classify that 100 units of 2-bedroom each in that estate in the book of this real estate company? Who can try? Hello, who can attempt this question?
You classified him as an inventory to the real estate.
Alright, Mr. Toby Loba, thank you. Who else?
Due to the due to the nature of the business, although the estate is a non-current asset, but due to the nature of the business, I think those 100 units of flats will be an inventory because of the nature of the man's business.
Good. This shows we are following. Yes, due to the nature of the man's business, it is an inventory and it should be classified as a current asset, which is an inventory, because that is the business of the man. That is the nature of the business. So that 100 units can be seen as a stock in trade, which is inventory in the ordinary course of business. Now, inventory can be finished goods to some people. That same finished goods can be raw material to others, right? Or part of production process to others. Now, take for instance a seller that sells nails. To him, the nails are inventory as stock in trade, finished goods. But to a carpenter, that nail is part of his raw materials, part of his production process. So, for a better understanding of inventory, you must first of all understand the nature of the business you are dealing with, right? So, now, what does IAS2 say about inventory, about the measurement of inventory? Measurement of inventory, according to IAS2, inventory must be measured at the lower of cost and net realizable value. So the lower of cost and net realizable value. So what are the costs that can be recognized as cost of inventory? Can anybody try and mention one or two?
The initial cost of the assets.
All right, that's a purchase cost of the inventory. Who else?
So costs to bring in the inventory to the warehouse or where it's going to be stored as well.
All right, all right. Another one. Any other person? Okay.
Installation or dismantling, like um the process of installing the assets to be used, like to place it in the condition where it can be used appropriately.
All right. So, Alice, thank you. You are talking about a non-current asset here, but it still applies to inventory. But that can be taken as conversion cost of conversion. In the case that the inventory you purchase needs some conversion or needs some fine-tuning, then you can recognize the cost of conversion as part of the inventory cost. Production overhead, like variable overhead. Okay, Benita, you said I should record a question, right? Excuse me. All right. The question is, we have different costs of inventory. Then I asked we should list the cost. That is what some of us have listed already. Or is that not the question you are talking about? All right, so you get it now, right? All right, you are welcome. So we have production overhead. We have both variable and fixed can be recognized also as part of inventory cost. So we have discussed cost of inventory. What is the net realizable value of an inventory? That is what we are looking at now. Net realizable value simply means the amount you can sell the inventory in the case you want to sell off the inventory. The amount you can realize from it minus all the selling cost of the inventory. That is net realizable value. So IAS2 is saying that if you want to recognize your inventory in the financial statement, you should use the lower of the cost or the cost associated with the inventory and the net realizable value. Which of them is lowest? That is what you will pick. So if you pick a financial statement and you see inventory, right? You see inventory in the financial position, statement of financial position. It is talking about any amount you see there. Know that it is the lower of cost and net realizable value. I hope you understand the concept of lower of cost and net realizable value now.
Yes, we do.
Yes, sir.
Thank you.
All right. So okay, so let's continue. So from there we go to inventory valuation methods, right? According to the standard, we have two major inventory valuation methods, which is the weighted average method and the FIFO method, that is first in first out method, right? So these two methods value inventory differently. What the FIFO method is talking about is the first item of inventory into the warehouse or into this the store should be the first to go out. That is first in, first out. Then the weighted average is saying when you have inventory or you receive inventory at two different times, the total unit should be divided over, or should be divided by the total value should be divided by the total unit to get the cost of that inventory, so that you measure it or you compare it with the net realizable value to know how much you should recognize. And in the case of issuing the inventory, to know how much you should issue the inventory. Now, inventory in itself has double entries, right? We know that inventory affects cost of sales. Inventory also affects asset. So the unit of inventory sold can increase revenue and also increase cost of sales and decrease asset. Is that clear? Then the unit of inventory remaining in stock at the balance sheet date, that is at the end of a financial year, can increase asset, reduce cost of sales, right? Because getting our cost of sales is opening stock plus purchases minus closing stock, right? So if you have higher inventory, if you have much inventory in stock, it will definitely reduce your cost of sales. But if maybe you purchase inventory during the financial year, but you have less inventory in stock at the end of the financial year, it will increase your sales, right, which is your revenue, and also increase your cost of sales. So the inventory valuation method you choose affects these elements of, or these line items in the financial statement. Any question for now?
No, sir.
Okay, Daniel, you raised up your hand.
Yes, sir. Thank you very much, sir. So I don't seem to get the inventory valuation method. I don't know if you can shed more light on it.
All right. So inventory valuation methods. All right. So inventory valuation methods are the method of valuing your inventory in stock, right? Now, take for instance, January, you bought 50 units of inventory at 10 naira each, right? The value will be 10 naira multiplied by 50. That is the total value. Then March, you purchased inventory at you purchase 100 units at 20 naira each. If you want to issue, let's say April, there is a demand from the production team to issue 30 units. You have 50 and 100, right, with different prices. At what price are you going to issue to the production team? Because you need to issue at a cost so that you know what to record against the inventory in your own inventory card. So which of these are you going to issue at? We have 10 naira and we have 20 naira. So using the FIFO inventory valuation method, which is first in first out, the standard say you should issue out of the 50 units that you have before you issue from the 100 units. Completely finish the 50 units before you go to the 100 units. And when you are issuing from the 50 units, it will be at the price of 10 naira, which is the price of the 50 units. That is FIFO method, first in first out method. Then we talk about the weighted average. Weighted average is not waiting for you to issue the first one first. Weighted average is saying if you have two inventory dates, add them together, add the units together, add the value also together. That is 20 naira multiplied by 100 units, then 10 naira multiplied by 50 units. Divide them by 150. Any amount it gives you, that is the amount you issue your inventory at. Then anything you issue, any amount or any cost, you issue your inventory to the production team. That is what the production team will carry as their own cost of sales, right? Is that clear now?
Yes, sir, it's clear now. Thank you.
All right, you are welcome. So I want to list out these costs, right? Please pay attention. Then tell me which one is applicable to inventory. Which one should we add to the cost of inventory? I want to see if we understand what we are talking about here. Are we ready? Okay, let's go. So number one, cost of purchase. The cost that is in the vendor's invoice sent to you, right? That's number one. Number two, after sales warranty cost. After sales warranty cost. Number three, trade discounts on purchases. Number four, sales commission payable to sales agents. Number five, import duties. Number six, salaries of accounting department. Number 7, freight and insurance on purchases. Number 8, other handling costs relating to import. Then lastly, brokerage commission payable to indenting agents for arranging import. So which of these costs can we add to the cost of inventory? So who is talking? Okay, Mr. James, go ahead.
Yes, sir. Good evening, sir. I didn't hear everything, but I know I heard of cost of purchase. It should be there. The import duty should be there too. The other ones I can't remember others, but I'm sure of cost of purchase and import duties since they relate to the inventory.
All right. Thank you. Any other person?
We have handling costs, we have excise duties among the names mentioned.
All right. Please, who took note of all the costs that I called? If you can call the 9 costs, raise up your hand. Let me see. Okay, only 2 people. Okay, Mr. Gabriel. Mr. Gabriel David. Tell us the cost that should be included.
Okay. I think other handling costs relating to import, then import duties, um, cost of purchase should also be there. I think those are the things to.
All right. Thank you. We are all correct in all we said. So thank God nobody say we should include the after sales warranty. Nobody say we should include sales commission payable to sales agents, and also salaries of accounting department. We thank God for that. So we go straight to disclosure requirements. The main disclosure requirements of IAS2 Mr. James, you raised up your hand.
Yes, sir. Please, before you continue, sorry. If you have people working in the factory, you understand? Let's assume it's the manufacturing company, and we have people working in the factory steadily. Do we also add their cost to it, or we just add the cost of the period they work for the production?
Okay. There is something we call direct cost, and there is something we call overhead. Right? Now, we have a production overhead and non-production overhead. Right? So, if we have people that work directly with the conversion of inventory, let's say conversion of raw material to finished goods, they are part of production cost. And according to the standard, production cost or conversion cost should be added to the cost of inventory. Did that answer your question?
Yes, sir.
All right. So we move to the disclosure requirement. I'm sorry, my battery is about to shut down. In the next 3 minutes it will shut down, and we don't have light. So